Lory, here you go, sir.
Very much. Okay, good evening, everybody. Fantastic to be here with you all. So thank you very much for coming along. We are talking about really, I guess, the hottest topic at the moment, which is stablecoins. Stablecoins, absolutely everywhere. I guess if we just take a step back for a moment, so the size of the stablecoin market, according to DeFi Llama today, 307 billion. We had Patrick Collison, the co-founder of Stripe, has called stablecoins, they're at room temperature semiconductors for financial services. We're seeing a bunch of consortiums be set up. We have representation from that here. So ING, RBI, many others here in Europe setting up their own stablecoin initiatives. We're also seeing another consortium set up, focused, I guess, maybe more on the US side. We see Goldman, Santander, Citi, Deutsche Bank in that space as well. So we certainly have a lot to talk about, and most importantly, we have the right people to talk about it, which is excluding me, most definitely, by these wonderful people beside me. So let's just jump straight into this, and we'll do a quick round of intros, and we'll come back, we'll jump into the first question. So, Coty, starting with you, please.
Nice to see all of you here today. I'm Coty de Monteverde. I'm leading crypto at Santander globally. I've been in the bank already 17 years, but 10 of them focusing on crypto and digital assets.
Thank you.
Hubert Grignon Dumoulin. I'm part of the CACEIS bank, which is part of Crédit Agricole Group.
Hubert, I think you might just need to talk louder.
Okay. Yeah, louder. Then Hubert Grignon Dumoulin. I'm part of the CACEIS bank, which is part of the Crédit Agricole Group. And I'm in the digital asset business line that was created a year and a half ago.
Thank you. Vid?
Hi, everybody. My name is Vid Hribar. I'm part of group strategy of Raiffeisen Bank International. We're a mid-sized European bank focusing mostly on CE markets. RBI just recently joined the consortium of European banks that are planning to issue a euro stablecoin. So today I'll talk partially on behalf of RBI, partially on behalf of the consortium. Happy to be here.
Thank you, Vid. Ben?
Yeah, Ben Duve. I'm the global head of partnerships from GK8 by Galaxy, which is Galaxy Digital's crypto custody solution. Former central banker, former banking executive. So a little in crypto now, but a long time in the TradFi space.
Fantastic. Thank you, everybody. Okay, so most importantly, let's get into the meat of all this. So everybody's on the same page. All these terms are spoken about: stablecoins, tokenized deposits, CBDCs. Maybe, Coty, if you could just explain to us a little bit about what they are.
Okay. So in terms of technology, they all share the same foundation. Central bank digital currencies, tokenized deposits, stable coins, they are tokenized money on blockchain. So that means they are digital programmable objects that are represented on distributed ledger technology. And this comes with transformative features that you may already know, obviously. These new forms of money can be controlled directly by a person, by an app, by a device. They are composable. That means they can interact seamlessly with other digital assets and with smart contracts. They operate 24/7 instantaneously. And all those features make this not just electronic money on a new platform. It's a new paradigm, and it's going to bring many efficiencies to the financial ecosystem. What they differ, it's who is issuing these forms of money and what do they represent. So you know that CBDCs are issued by central banks. They represent funds that are held in central bank accounts. So it's a liability of central bank money. Tokenized deposits, it's just the bank deposits that you already know, that it's represented digitally on a blockchain, and stablecoins are issued by private sector companies, and they are backed by reserves mainly to have this stable value.
Okay, got it. Anyone, any other thoughts or explanations they want to share on those assets? No? Okay, let's go back into Santander for a second. Okay. You've got a very big job in Santander, leading this incredibly exciting new area. How are you seeing the evolution of tokenized deposits, of CBDCs, of stablecoins?
So I think that they will all coexist and complement each other. They will find its own use case. I don't think that they are going to compete one with the others. What it's obvious is that stablecoins are already here, and CBDCs are on their way, tokenized deposits far away to be massively used. And the evolution of them, it's going to depend mainly on regulatory clarity, interoperability, and there's also, well, I would say, politics. So we could end up in a fragmented ecosystem with different regional platforms. So we already see that MiCA is trying to protect the euro, so they are pushing for the digital euro rather than non-euro stable coins. In the US, we see that they are promoting private USD-denominated stable coins, but there doesn't look like there's going to be much interest in a central bank digital currency. So it might end up in different regional ecosystems, but we'll see.
Okay.
But maybe a small challenge to that. I to one extent, I do not agree, because there's a limited amount you use money. So there's a limited amount of transactions everybody does. There's a limited amount of trade. There's a limited amount of settlement. That's the finite number, so the wallet you have available. And there is a competition for who gets what percentage of the wallet share. That said, with regard to stable coins, deposits, central bank money, so the direct competition for that wallet share, as well as if you look at how global trade, how global settlement can happen, also from the different regions. They directly compete. How can my currency or my stable coin or whatever be used outside of my territory? So I think I agree on they will coexist, but I think there's a very tough competition out there on what will be used inside, outside blocks, and then the competition between the blocks. What's the actual currency, most useful way of currency in the future?
If I may, I would be a bit more nuanced on that because I would say you have categorization. I mean, clearly, wholesale payment is not the same as retail payment, and certainly you will have interbank wholesale payment that will continue to exist, including on-chain. But I mean, very large cooperative, they have to pay for, I don't know, a big acquisition, $1 billion of US dollar or 10 billion of US dollar. I don't think they're going to use a stable coin and a programmable wallet in order to do so.
Yeah, so I do agree that it will depend on the use case. The competition right now, I see it more theoretical because there's no CBDCs available yet. So I think that we are in an early stage and we'll see how it evolves. And I see that regulation, interoperability, and policy has a lot to decide on this.
Just to build on this, what Coty said. So we were also, I mean, of course, we're following the developments on the tokenized deposit side, on the wholesale CBDC side, but we deliberately decided to focus on stablecoins. Why? Because they are the only thing that is there right now for us. So when it comes to tokenized deposits, we're seeing that if you're a global GSIP, like JPM, Citi, HSBC, they are doing they're tokenizing their deposits, but they also have a completely different range, network, and the volumes that they are processing with these systems. For a bank of our size, it doesn't really make sense to tokenize deposits because we know that our tokenized deposits would have to be interoperable with other banks' tokenized deposits, right? And I still believe, and there are certain initiatives there, commercial bank money token in Germany, there was a POC in Switzerland, a pilot in the UK, but I still believe that this will take a while until these standards will be developed. That's why we also decided to focus on stablecoins, because this is the only thing that we can currently build where we have the regulation, the use cases, and also this opportunity to build something tangible.
Got it. Well, Vid, look, I think you've actually answered the question I was just about to ask you. You know, is it stable coins or tokenized deposits? It sounds like it's stable coins for you guys. Is that fair?
It's probably going to be long-term, all three of them, and I think that there will be a competition also on the use cases. But when we're looking at the landscape now, the only viable option for us are stablecoins.
Okay, I like it. Let's go back to you, Vid, right, for a second. So, and maybe you can kind of fill us in on some of the exciting work that you guys are doing. So, first of all, the consortium is being set up. I was going to say it's new, but it's probably new-ish. There's probably been a whole pile of work going on behind the scenes for a while. But maybe, I think for the audience, it'd be great to learn more as to, okay, like what it is, why it's happening in the first place, why now, and what happens next.
Exactly. So this work has been going on for the last 2.5 or even 3 years. We just announced 2 weeks ago that we're establishing a new entity that will issue Euro stablecoins. It will be established in Amsterdam. It will be a fully regulated e-money institution that will issue Euro stablecoins. And here the goal is really to provide a trusted, regulated means of payment and settlement on-chain that will support actually the growth of the digital asset market. This entity will, of course, also partner with third parties such as crypto exchanges, fintechs, PSPs, so it's not going to be a closed loop system. It's not just for the banks, but of course, one of the, let's say, our goals is also to nudge the banks to start developing the products and services around stablecoins. So definitely open also to collaboration with third parties, but the long-term goal is also to onboard the banks and to kind of bring them closer to the whole digital asset ecosystem.
And can other banks join up? If there are banks here that are interested, do they get in touch with you, or what happens?
Definitely. I mean, this is an open consortium. It was open from the beginning. We're currently 9 banks out of 8 different European countries, which is also, I believe, quite a success. But definitely, we will onboard the other banks in the future.
One other question, if I may, right? When it comes to consortiums, what's it like working together? You know, it's hard work to get everybody aligned. You know, can you talk a little bit about that?
To be honest, when we started, I thought it's going to be extremely hard to align with the other banks. But we started with 4 banks, and actually we shared a common vision to really have a Euro stablecoin that is governed by the banks. And I think that this shared vision also helped us to kind of overcome this problem. So from my perspective, this was one of the best collaborations that I could wish for.
Okay, long may that last. I also mentioned the other consortium there that was happening in the US, Santander, Goldman, Deutsche, and others. How is that different to what you're doing?
I think I have to clarify some things. So the media has interpreted that we are going to issue stablecoin, but the main difference with the consortium that Vid has just described is that this is not a consortium yet. It's just a group of banks getting together to explore if it makes sense to do anything on one-to-one fully backed by reserves, new forms of money, but we have not decided that we are going to establish a company. We have not decided what we are going to do yet, so this is an early stage exploration, not even a consortium.
Coty, you're always welcome to join. You're always welcome to join.
Okay.
We could join forces.
Okay, you heard it here first, right? Magic happens here. Okay, I like it. So, okay, let's move on. Hubert, let's talk about regulation, right? There's just no panel without that conversation, whether we like it or not. And I think regulation is seen sometimes as a brake, or it's seen as an enabler. So, should we see, I guess, regulation as something that is slowing innovation, or actually it's a necessary evil which provides rules of the road and then results in adoption?
Okay. For this question, maybe I will focus mainly on the European situation. I mean, clearly at first, MiCA was an enabler, because you can see that, I would say, stablecoins are no more private money. You have banks who have joined this adventure to issue stablecoin, banking circle, for instance, Odo BHF. You have also SocGen with Forge. Then it means that you have additional competition. That's one thing. where in fact on this crypto ecosystem, banks are starting to move in that area. And if there was no legislation such as MiCA, I'm pretty sure that there would be no bank on the stablecoin area. That's one thing. Obviously, one of the drawback is that if you have legislation, it's rather static. For instance, you have now the US legislation with the Genius Act, and you can see that there will be a big debate between whether you have remuneration or no remuneration on stable coins. For instance, in the EU, clearly there is no remuneration. In the US, there is no remuneration, but the secondary legislation might open the door on that. And I would say the concept of reward is very well developed in the US on that. That means then it's not all stablecoins are equal, at least on that topic. Yeah. And there are other things which are of importance. In Europe now, there was the need of an immediate quick fix on stablecoin, where in fact they are amending the payment service regulation for that in order to recognize that crypto assets is liquidity, cash, which means also it's not an investment product. And that's a bit odd compared to other region, yeah.
Got it. Ben, if I can ask you that question, just to kind of pick your brain. Obviously, experience working in a big global bank, experience working with the ECB, now you're in a global role. If there are all these different rules, how does it all come together?
So I think the foundation has been laid for digital dollar dominance, right? If you look at how everything is structured, and maybe add some context around it. So as GK8, we power all Unity, which is a DWS, Galaxy, and Flow Traders Euro stablecoin, right? So for an individual company, I think the opportunity is great because there's 0 or less than 1% usage of Euro stablecoins in the digital environment. So as an individual company, you really have the ability to gain market share, right? And it's a GSIB-backed stablecoin indirectly, right? DWS is Deutsche Bank, so I think that's a very interesting value proposition. But that's on the individual company's level. The ability is, do I gain up to 20%, or how much do I gain of the 20% Euro usually has in that global currency environment? But if you then zoom out and go on that macro perspective, you see two fundamentally different ways stablecoin functions. You have a US dollar stablecoin right now, which is not regulated, it's Tether, right? And they are regulated in certain countries, but they're widely accepted, seem to have very stringent rules around their reserves, and it works quite well for the market in crypto and digital right now, right? And that together with USDC is what 90% of the market right now or more, right? And that's dollar, right? All dollar based. If you then look at the next iteration, and you mentioned it before, Genius Act and so on. So in the US, you now have a new stablecoin regime where you get through a stablecoin company which is regulated and checked by the US government, direct access to a digital currency which is backed by US treasuries. So you have the US government debt one-to-one backing, or more or less one-to-one, and there's some liquidity reserves in it, backing a stablecoin, right? And the government audits to make sure the stablecoin is there. So I think there already is a fundamental difference, because when you look at Europe, you have a stablecoin which is banked by bank deposits. We all know the difference between the asset safety you have on a bank deposit, right, versus a government bond. There's a stringent difference. There's an insolvency risk. You know, all of that exists. Plus, you have the risk of the underlying bonds. Why do I say that? Well, is the rating for all European banks the same? No. Is the rating for all European government debt the same? No. So you have a euro. So basically, it's the structural problem the euro have. You now have a stable coin as well. You have a credit risk. It says euro, but it could be actually solely one European country and only the banks more or less in that European country, right? It's a little overdone, but the risk you have there is completely different. So you have now a stable coin, which is dollar and more or less backed by the US government, versus a euro stable coin, where you really have to look into the fine print, how risky is. The second issue I think we should never underestimate is dollar dominance, right? People, what do people want? And we saw that in Turkey now and Argentina and other countries. They want access to US dollars. Now you have a regulated US stablecoin which an American bank cannot touch, right? We have these discussions, I have them with American banks. They said, my clients want to send Tether to Latin America. I'm an American bank, I cannot touch Tether. So they do USDC. The more of these stable coins arrive that had a wide variety of acceptance, the more likely is that first the remittances out of the US, and that's huge amounts of money, and Coty probably has good insights with Santander operating in Latin America. So that money goes out. What happens? Do people then take that money and convert it into a local currency, or, which is high inflation currency, or because they're now happy, it's a government, US government-backed currency, it's audited, I'm quite safe, it's a great store of value, and then they suddenly start transacting. What does transaction means? Everybody with a smartphone can send another person a stablecoin. So the guy in the local store will also more likely want a stablecoin, right? Because that's dollar. It's just an easy way to transact in dollar. Now, think of that at companies. Companies get paid in dollars already nowadays in trade. Why would they go into their local currency? The moment you have the ecosystem of people and small stores who accept the stablecoins, you will be able to pay your local staff in US dollar stablecoins. So that dollar dominance goes all the way, and the ecosystem is being built, while Europe already has a small role in that area. Now it's getting smaller and smaller, also because of the stringent rule, and I think interest might pay another reason. I mean, you're not allowed to pay interest on US dollar stablecoins, but you're allowed to pay incentives, and it looks like exchanges are the ones who are able to provide those incentives, so you have interest.
So this sounds like a subject almost that should come up at the World Economic Forum in February. This sounds like a serious issue, and also one that if I'm a normal euro stablecoin holder, I need to know about those risks. Hubert, what were you going to say?
Yeah, if I may also, I mean, for me, the legal presentation of a stablecoin issue is not necessarily fully accurate for me. When you buy a stablecoin, you don't have a direct claim on the reserve of the assets. You have a direct claim on the issuer, which is most of the time an SPV, and that makes a significant difference. That's why you have this hierarchy between, I would say, the CBDC, where you have a direct claim on the central bank. Then on tokenized deposit, you have a direct claim on the bank, and that's linked to the final standing of the bank. And then on the stablecoin issuers, you have a direct claim on the SPV. And okay, you have the reserve system, but you don't have a direct right on the reserve. That's a bit different. If you have a bankruptcy, you need to go to the court in order to get back your potential part of this reserve. And that's not so easy. That's why I think the main stablecoin issuers, they will sooner or later move to the bank status. They will ask banking license, and because that's key in the protection of the asset owner.
But that means, you know, if you think that through, I'm someone maybe outside of Europe or who transacts in US dollars, right? The insolvency of a bank means I'm insured up to the maximum scheme of the bank, or if I'm a corporate, it's not insured at all, right? It depends on the country and the jurisdiction. Or I have an insolvency of a stablecoin issuer, and the underlying is US dollar denominated US treasuries, which have a market value of 100%, right? So the risk, if you talk about insolvency, about all these topics, is much lower on stablecoins. So the deposit flight that could happen out of that is tremendous.
Hubert, what do you think?
I don't agree on that presentation, meaning that clearly, I mean, if something goes wrong, and we have seen that, for instance, in the context of the flash crash a week ago, some stablecoins are completely depegged, a small number of stablecoins, but you had the opposite. At a certain point of time, people were forced to buy USDT at $1.07.
But those were not regulated. Those were not regulated ones. Those were synthetic stablecoins and DeFi stablecoins. It had nothing to do with a regulated regulated stablecoin in the U.S. under the Genius Act.
So okay, let's look to kind of close this piece for a second. But so Ben, what's the solution? Where do we go from here? What's the right outcome?
Well, it's a tricky one, right? Because you have the credit transformation of banks, right? So you get a bank deposit, and in Europe, we strongly depend on bank credit for the real economy, right? So that's one of the main functions of banks. If we enable stablecoins too much, it could starve banks of bank deposits, as well as the digital euro could, right? That's the central bank money in Europe has potentially the same effect, right? So that's a very tricky one for Europe. It's a very difficult topic to answer because you need the deposits and banks in Europe. That's very important for the real economy. But in a global context, it makes stablecoins not as competitive. That's one, right? And the second bit is, are we willing to give that up, that in the new digital age, Europe plays a much smaller role?
Okay, thank you. Let's switch gears for a second. Vid, let's talk about my mom. What I mean by that is, right, when it comes to stablecoins, generally, like, what's the benefit? The work that you're doing in the consortium, why should the average Joe or Jane care about stablecoins?
Yeah. So there are a lot of discussions also around the yield-bearing stablecoins, and I would try to explain this from this perspective. So I think that now in this current system, we're used that our traditional bank accounts are used on one side for payments, but also for storing value. And also the yield is basically generated on this. I think that now this is becoming a bit more modular and that stable coins are actually becoming just a transaction instrument. What does this mean? Stable coins enable faster, cheaper, more efficient transactions, enable also the programmable logic. This is something that you cannot do that easily with the traditional rails. So from this perspective, I also think that when it comes to the yield and when it comes to your mom earning, let's say, some yield on her money, I don't think that stablecoins will bear yield natively. But I definitely think that we should provide a way how this yield is generated. And I have this vision that in the future, payments will be done 24/7 instantaneously, globally. Also, when it comes to investment portfolios, this will be so the trading will be done 24/7 instantaneously, also settled instantaneously. And I think that for this kind of cases, stablecoins are a really good instrument. So from this perspective, yeah, I do believe that stablecoins do bring value, but when it comes to the yield discussion, we have to provide yield somehow, but I think that there are other ways than providing yield natively.
So it's a utility rather than the store of value argument you're making. So it's not the store of value. You want that still as a bank deposit, but the utility of the stablecoin, right? Then if you think about that, I think the technical thing to think about is how fast can you go from a bank deposit into a stablecoin and back, right? So you have the utility, the global piece, your bank runs 24 hours, you can move the money around, but it resolves back into your bank deposit, and that would be one of the examples how you can solve, at least for the European aspect, some of it, if the money doesn't stay in the stablecoin but goes back into deposit, or it's seen like a bank deposit, right? That's another way to do it.
I would summarize it as that a yield attracts the attention, but the utility is what drives the adoption, right?
I think that two use cases, right? Store of value when you're somewhere else, or utility maybe as a European, right? I think that's why I always I'm quite cautious around the CBDC and stablecoins in Europe. I think In Europe, the utility drives it because we have a very well-functioning banking system. We don't have people who are unbanked. We don't, all the problems allegedly out there, they don't exist, really, where everything works quite flawlessly. So it's the additional utility we can generate of a stablecoin, that's the value. Versus, I think, in the dollar space, the store of value argument for people outside of the US, it's so strong. So it's actually two different use cases, right? And then if you compete for store of value, interest is important. If you compete for utility, it might not be that relevant. If you're a global corporate, if you send money around, I mean, we all did that, and it costs 50, 100 euros to send money somewhere. How long do you have to get 4% on that amount of money to pay off the difference between a 100 euro wire transfer versus a 50-cent transfer, right? So I agree. I think it depends, two use cases, utility and then store of value. Store of value might be more the dollar-based one in the long run, I don't know, and the utility could be more the European one.
Yeah, look, I think the whole thing of stablecoins has asked a massive question, and it's really based on Tether, in my view. Tether has shown how much money they can make through net interest margin. Other institutions have become aware of that, but also the end user is seeing, and I think is more educated than ever, as to how much money banks are making through net interest margin, are asking the question, why can't I get a piece of that pie? And so yield for me, look, I'm biased, you know where I'm coming from, is going to be the next big play around stablecoins. It's kind of stablecoins are interesting, but then it's how do I get them to do stuff for me? How do I benefit from them?
How to delineate the underlying collateral from the stablecoin for the amount of time it's unused, right? Then you can, like in a repo kind of environment, you can still immediately earn yield, right? And that will be the very interesting discussion, but it's a regulatory question or it's a technical question.
Okay, well, it's a question which we'll come back to definitely at another time, because I want to close out with the last question. So, look, let's flash forward. I know every panel's doing this. This, unfortunately, is definitely the same. So, as we look into 2030, what do you see as being the format of digital money? Coty, we'll start with you.
What I see that it's...
What is the form or format? What will digital money look like
when?
in 2030?
Oh, that's only 4 years.
Okay, well, then you got to be more
that's
right.
Too close. I mean, for cross-border payments, I see definitely stable coins. We are already seeing several platforms that do the stable coin sandwich that they call. Well, I mean, some of them are being in development, so I expect that in 4 years, this is going to be a more efficient way of sending money overseas using the stable coins as settlement asset. I hope that in 4 years, there will be more developments around interoperability solutions for tokenized deposits, so we start looking at more mature use cases than what we have right now.
Thank you very much, Hubert.
It's a difficult question, obviously. I think, again, I mean, at the beginning, we start with the comparison with CBDC, tokenized deposit, and securities token. For me, they will coexist. Proportion, it's unclear. Certainly, we need a payment on-chain, but the format right now, for me, it's not obvious, because I would say all competitors have their chance on that. Yeah.
Perfect, thank you very much. Vid?
Yeah, it's a boring answer, but I do believe that tokenized deposits, wholesale CBDC, and also stablecoins will coexist in the future. But I think one is clear, that currently we have this opportunity to build stablecoins and to develop products and services on top of that. When it comes to tokenized deposits and wholesale CBDC, we can talk about it, we can develop this, but this is not something that is there in the short term.
Ben, please.
So from my perspective, I think we see very little change. Having worked in a bank, having worked at the central bank just now, I think the progress will be much slower than we think. So your day-to-day activities will not change. What we will see is two things. We see in the digital arena, so crypto digital arena, such a proliferation of stablecoins and a true race of what is, if there's a fully free market, how the future could look like. So you might in 2030 be able to see a little bit more how a stablecoin infused financial ecosystem with yield, with earn strategies, with everything could look like. And the second thing, I think it goes a little bit in line with Coty, but maybe phrased differently. I think we will see a lot of players who will use stablecoin in, for example, cross-border transaction, but others where there's very high value added or high value extracted currently through banking and other intermediaries. And if you can use a stablecoin to bypass that, you will use a stablecoin. So it's basically an arbitrage opportunity to move revenue and fees away from current players to you as a new player. And they will be much more aggressive pursuing that, and cross-border is a great example, but I think there are quite a few others.
Okay. Well, Coty, Hubert, Vid, Ben, if we could give them a big round of applause, thank you very much. That was excellent. Thank you.
Thanks.
Thank you.